You know, every great business starts with just an idea. But an idea by itself is just a thought, right? So what's the magic that turns that thought into a real, living, breathing company? It's not just about having money, it's about the smart management of that money. And that, my friends, is corporate finance. Think of it as the engine that takes the blueprint and actually builds the skyscraper.
So here's what we're going to cover. First, we'll nail down exactly what corporate finance is. Then we'll get into the two, and really only two, key decisions that matter. After that, you'll see just how much finance touches every single part of a company. And finally, we'll look at the two kinds of fuel that keep the whole machine running: fixed and working capital.
All right, so let's dive right in. What exactly is corporate finance? Well, before any company can build a product, grow its team, or innovate, it needs a rock-solid foundation. And that foundation, it's built with finance. If you get this part right, pretty much anything else becomes possible.
I mean, just imagine for a second. Let's say you have a brilliant idea, a game-changing app, a revolutionary new service. How do you take that initial spark and turn it into a real, functioning company? The answer, every single time, is finance. It is the bridge that gets you from a concept to a commercial reality.
You know, you can find a lot of complex definitions out there, but this classic one from Henry Hoagland just boils it all down perfectly. It's all about two words: acquisition and use. That's it. First, you acquire the capital. That's the getting the money part. Then, you use that capital wisely. That's the spending it right part. The entire vast field of corporate finance really just lives inside those two simple actions. Okay, so if it's all about acquisition and use, how does that translate into actual day-to-day action? Well, it all comes down to two critical decisions. I'm not exaggerating when I say that if you get these right, a business thrives. Get them wrong, and even the most brilliant idea in the world can totally fall flat. It's basically a two-step dance. First up is the financing decision. This is where the company asks, okay, how are we going to get the money? You could sell off little pieces of ownership in the company, which we call equity, or you could borrow the money, which is called debt. The big goal here is to find the right mix of those two at the lowest possible cost. Then, once you have the money, comes the investment decision. Now, what do we do with it? How do you put that capital to work to make the biggest possible return for the people who own the company? And this, right here, this is the golden rule. It's the one principle that governs everything else. It really doesn't matter how you got the money or what you invested it in if your returns don't beat your costs. It's that simple. If it costs you, say, 5% to raise $1, your investments have to generate more than 5%. That is the bottom line, always. So we get the decisions, but you might be thinking, okay, that's for the finance department. Why should a marketing manager or an engineer really care? Well, because corporate finance isn't some function tucked away in a back office. As you're about to see, its decisions send ripples through every single part of the business. Just think about it for a second. Finance isn't just about numbers on a spreadsheet. It's the lifeblood of everything a company wants to do. You want to launch a new project? You need funding. You need to pour money into R&D to stay ahead of the competition? Finance makes that happen. Even the absolute basics, paying salaries, buying supplies, keeping the lights on, all of that depends on a well-oiled financial machine. From managing a sudden drop in sales to paying out dividends to your investors, finance is really the company's central nervous system. Without it, the whole body just shuts down. Now, to keep that business engine humming along, a company needs two very different kinds of fuel. We call them fixed capital and working capital. So let's break down exactly what they are, because understanding the difference between them is absolutely crucial. First up, we have fixed capital. The easiest way to think about this is as the skeleton of the business. It's the big, chunky, long-term stuff. We're talking about the factory itself, the land it's sitting on, the fleet of delivery trucks, the heavy machinery. These are the assets that a company buys with the intention of using them for years and years to create value. You're not looking to flip these for a quick profit.
And then you have working capital. Now, if fixed capital is the factory, think of working capital as the electricity that keeps the lights on and the raw materials that are constantly flowing into the machines. This is the money that greases the wheels of the day-to-day operations, paying your suppliers, managing your inventory, and just covering all of those immediate ongoing expenses.
This little chart breaks down the differences perfectly. Let's walk through it. First, look at the purpose. Fixed is for buying the big stuff, land, buildings. Working is for the daily grind. Then, duration. This one's huge. Fixed capital is basically permanent. It's locked into the business for the long haul. And because of that, the risk is much higher. Working capital, on the other hand, is constantly moving. It circulates, making it way less risky.
And that difference directly affects their sources. You fund big, risky, long-term assets with long-term money, like selling shares or issuing bonds. You fund the short-term stuff with short-term loans and credit from your suppliers. See how it all connects?
I really want you to focus on that phrase right there, circulating capital. That is such a powerful way to think about this. Working capital isn't just some pile of cash sitting in a bank account. It's constantly moving, it's changing form, and it's flowing through the business in a continuous cycle.
So what does that cycle actually look like in the real world? Well, it starts with cash. The business uses that cash to buy raw materials. Those raw materials get turned into finished goods, which become inventory. Then that inventory gets sold, usually on credit, which creates what we call receivables. That's basically an IOU from your customer. And finally, when the customer pays their bill, those receivables turn right back into cash. And boom, the whole cycle is ready to start all over again. This constant flow is literally the financial heartbeat of a company.
So when you put it all together, it's clear. Every business needs both. It needs that long-term, solid foundation of fixed capital, and it needs the short-term, flexible fuel of working capital. And that brings us to the ultimate million-dollar question for every single financial manager out there. What's the perfect mix? If you lock up too much capital in fixed assets, you might not have enough cash to pay your bills. But if you have too much cash just sitting around as working capital, you're not investing in future growth. Finding that perfect balance, that knife's edge, well, that is the true art and science of corporate finance.